What is a bear trap? A bear trap is a technical pattern that occurs when the price actions over a stock index or any other financial instruments inappropriately signals the reversals to the upward trend from the downward trend. The technical analyst will say that institutional trades create bear traps to tempt retail investors to attain a long position. If the trader gets successful and the price moves higher, it gives the ability to unload massive positions that will push prices lower. In today's video, we are showing you everything you need to know about the bear trap. So, without further ado, let's begin with the video. Some of the special considerations. The bear trap can prompt the market participant to expect a deadline in the financial instrument's value, prompting the asset's short positions for execution. However, the asset value stays flat and rallies in the case, and the participant is further forced to incur the loss. The trader will sell the decline in asset to retain profits, while the trader will attempt to short that asset to buy it back after the price gets dropped to a particular level. If that downward trend will not occur after a short period, the price is identified as a bear trap. Market participants will rely on technical patterns to evaluate investment strategies and analyze market trends. For example, technical traders will attempt to identify bear traps and then avoid them by using various analytical tools, including relative strength oscillators, Fibonacci retracements, and some volume indicators. The tools will help the trader to predict and understand whether the current price trend of the security is sustainable and legitimate. So, how does a bear trap work? In some of the investment markets, various investors are looking to buy the stocks, but some sellers are also willing to accept the bids they offer. In this case, the buyers will increase the bid and the price they are willing to pay for the stock. This will captivate higher sellers to the market, and the market will move higher because of the imbalance between the pressure of buying and selling. However, when the stocks are attained, there will be selling pressure automatically on the stock because the investors will earn profits when they sell. If there are too many people buying the stock, it will diminish the buying pressure and increment the potential selling pressure. To increase the demand or get the stock prices to rise, institutions will push prices lower so the market will appear bearish. This will cause the investors to sell stocks, and once the stock prices drop, the investor jumps back to the market and the price will rise with the rise in demand. So, this is all about bear traps. In the comments below, let us know your view on the bear trap thing. Stay tuned and subscribe to our channel for more uploads like this. Until the next video, see you soon.